Legend says that all Bitcoiners are like, I'm in it for the technology. So today we're gonna discuss over the technical charts of prices. No. Okay. Not only technicals of price patterns, but we will discuss the most important aspects of crypto and also stock market, because Blockrevision is a series, educational series, where you find the most important news about the fundamentals of stocks, cryptos, and also price predictions, just to not put you all this raw data without explanation. So you will find here the newest trends and also trades ideas. If you just here for the trade idea, just look at the the description of a video. You will find the timeline of this exactly section. But to not overrun this intro, let's get straight to the first section. And we are as of first getting to market of a section, and as you can see, GDP growth rate for euro area year over year that has been published today has nearly met the expectations of 13.6. So it's the biggest growth rate of GDP in its modern history, or even the whole history. So after this dump, we can see just the firm rebound. And right now I'd like to get to economy view section, and we are observing a indicator that is known as Marshall K. It's literally a gap between the rates of growth in money supply and gross domestic product. As we can see, right now we have just get to this negative territory that may indicate that we are right now approaching another major slump in the stock market. So previously this negative territory has been seen in the 2018, meaning GDP is right now rising faster than the government's M2 account. And US economists may explain this situation as US economy drinking from a punch bowl that the stock market has all to itself. So we need to take a notice on that. US economy doesn't imitate one-to-one US stock market. US stock market growth is an aftermath of such factors as stimulus checks, diluting US currency, and also some inflationary pressure. So investors just want to hedge against this last factor. On the other hand, US economy is struggling with getting back to this very strong trajectory that US economy was before pandemic. And right now such indicators as GDP growth or strong PMIs doesn't really indicate the strength of the economy itself, but rather just rebounds after this last year's slump. So it's very important to just remember about that as we are right now in this environment where money supply and gross domestic product are so detached from themselves, it may bring some unfortunately risk of stock market to finally make a correction, at least correction, or not get even to the downturn for the longer period of time. And this finally looks like liquidity is been pumped in from every angle of government, but yet it's not enough to cover such a gap. And one of the reasons this liquidity to evaporate is the growth of total social financing in China slowed in the first half of 2021. Just look at the recent indicator when we could find a broad measure of credit and liquidity in the economy that just have went down to 1.06 trillion in July 2021 from 3.67. So it's a very strong drop. So China is cracking down on shadow banking, decreased off-balance sheet borrowing, and it also stems from a bond issuance that just returned to normal after a surge last year to balance the pandemic's economic impact. So I'm just highlighting that the more China's banks are loaning out outside, obviously it leads to an economic growth. So right now we can find that this has a lagging effect on the rest of the world. If China starts to slow down, everything starts to feel it afterwards. So we can also find that that may bring us finally to the situation where we'll find deflation. So we will not have enough cash on our deposits to cover or to face this inflation, and in the reverse operation, the deflation may turn up. And looking at this gauge exactly, retail sales has literally plunged to this below 10% level year over year. So it may show you how ferocious effects this grabbing money of Chinese table may have on Chinese economy. So we have just addicted ourselves from this fiscal drip that is going on, and without this we are like a stew that can't really survive, and without this we are like a stew that can't really survive without another bottle of vodka. And this very weak retail sales has been hit by tough new virus restrictions, also weak auto sales due to chip shortage, and also we have just reduced output of steel and cement that is hitting commodity demand. And hard to swallow fact is that this Chinese economy growth loses its steam amid this COVID resurgence, and other factors may mirror on the rest of the world, where we could see further headwinds to growth momentum. So it may impact, unfortunately, the areas from supply chain disruptions up to slower than expected normalized consumption. And due to the fact of lowering sentiment on Chinese and Asian markets, PBOC is trying to back up another plan to boost its growth and roll over most of its medium-term policy loans coming due to move to support economic growth amid a resurgence of COVID cases. So government bonds also has reversed after recent losses. So we can find we are not don't want to get out of this growth pace, and want to just remain in this level that was kept throughout recent months. So also banks around the world are already bracing for a September leveraged buyout boom. So banks are increasingly selling off short-term loans they made to fund leveraged buyouts, a sign that they are freeing capacity to lend even more in the coming months. So we are in this environment where banks are aware of this liquidity and credits problems, but on the other hand, trying to just keep the pace of recent growth. And as we can see, even high yield bond market hasn't seen this many sales of short-term bridge loans since before COVID disrupted deal making. And the question that remains, will government will find a solution in order to gap up this drying up liquidity problem of stock markets and also other sectors of economy, or rather we will see a very, very fierce slump on the both areas this fall or winter. And threats of this downturn to happen is not groundless, just as more and more companies' balance sheets are stacked with cash and just short-term investments. As we can find here, companies are sitting on a record amount of cash amid lingering uncertainty about disruptions from COVID, defying expectations earlier this year that a waning pandemic would unleash a spending spree. And the picture of this economy that we are right now at is not improved also but by this exactly a problem that world's third busiest port remains partially shut in China. As we can find, there is a fear that this new disruption will further strain shipping and supplies of goods, and it will finally even dampen growth and driving up prices. Just look at this indicator of cost of shipping goods from China that is right now continuing to soar. And pulling up this COVID topic, Bank of Thailand head says virus fight may need lots of more billions of US dollars in government spending to counter COVID. So the trust in such entities, such Fed and other major central banks is descending as traders are piling into tail risk bets that it won't hike at all. And as we can see below at the chart, the option target for March 2025 in terms of interest rates is at 0.5%. However, the euro-dollar implied rates outlook is getting by 2025 up to 1.5%. So option hedge pays off if markets price 3-month labor below 0.5% in 2025. Labor has been subject to some manipulation in the past, so right now it's getting less and less credible today as a benchmark rate. However, it indicates what is the sentiment of traders, just putting aside the manipulatory aspects, but just look at this problem around economy, and remaining this very low interest rates level by that time would be devastating for the economy. Just look at this loss situation that would be savers that lose due to negative real interest rates, and also consumers that lose due to high inflation. So no one except for maybe Fed will really enjoy such turnaround. And let's get to crypto outlook section. For those of you that watch to our episodes, you probably know that I'm a huge proponent of crypto industry. Not only because it brings a unprecedented possibilities in terms of returns on investments, but also it gives people freedom because lots of cryptocurrencies are highly independent on any entities. So just evolutionary in terms of what are investment assets and what is really technology about. So as we can find, whenever I'm just claim that crypto industry or crypto market rather is going downturn, it doesn't mean it goes downside fundamentally. And most often it's because this crypto market is probably getting through some upsides and downsides. So it means rather that price is volatile than rather the industry is volatile. So industry is developing all the time. But this time crypto market retakes 2 trillion market cap amid Bitcoin gains. So it's something to celebrate about for lots of Bitcoin and crypto proponents. And as we can see, we are right now flirting with this 200 MA line that we just have crossed on the high volume, and it just shows us the strength of this Bitcoin market and the confidence of which we are just getting straight to this 50k can also brings us some positive forecast for the future that we may also get through this psychologically important resistance. And look at this specific chart. The OpenSea monthly transaction volume since launch has nearly get $1 billion. So NFTs are units of data stored on a blockchain. Blockchain is something that certifies digital assets to be unique and interchangeable. So OpenSea is just a peer-to-peer marketplace for those NFTs and also some rare digital items and also crypto collectibles. So it's a huge milestones for this newly developed industry. And look at this exceptional chart, miner revenue per hash for Bitcoin. We can find that during last month, this pink line that has been marked symbolizes miner revenue per hash, and during last month we have entered positive territory. So it means every single miner that was joining infrastructure of Bitcoin has noted a positive return on investment at once. So that was the environment that was very attracting to new miners. And after this Chinese miners exodus period throughout May and June, we have recovered in terms of this self-adjusting process of attracting new possible miners. And with this profitability, Bitcoin has gained lots new miners to the infrastructure. So right now, as we are balancing around zero territory, it's very important to keep up with its miner net position change to the upside. And this upside will help this hash rate to regain to its recent levels, and also may bring a recovery to the whole infrastructure. And if you'd like to point out one indicator that we may owe our recent growth of cryptos, is that regulators has finally come to its senses, and we have probably have staved off biggest crypto fear of recent, that the Senate will tax any service effectuating transfers of digital assets on behalf of other persons. So the Treasury won't go after crypto entities that don't meet the tax code's definitions of a broker, and this guidance will come to us probably next week, as report says. So it's a great news for the crypto industry. Fortunately, crypto regulators of US not trying to stifle the innovation as we thought previously, and trying to maybe better understand this decentralized universe in terms of taking an advantage for the US economy of it. And just to sum up, we may admit that US reporting requirements, as of this case, made probably, maybe not solely, but made a path back to $2 trillion for digital tokens industry. And that interest in Bitcoin and Ethereum is rising recently. We can find also in JP Morgan report that futures contracts right now has found a pivotal moment in June, and right now are rising. So despite this maybe a bit muted price action as of recent, institutions as JP Morgan wrap up its document are in fact loading up on a train. So this one picture is showing us the significant impulse of assessments of the net positioning change by investors in CME Bitcoin. And as we can see on this trajectory, if this similar interest of investors for Ethereum and Bitcoin will stay the same, the trajectory of a future market cap of Ethereum may bring us to the point where this exactly crypto will overpass the market dominant that is a Bitcoin. So this overpass may happen in the future, but it's a still long road ahead of this second in terms of market cap cryptocurrency. And in today's trade idea section, I have nothing more or less for you than Apple stock. So Apple stock is one of the most recognizable phone mobile brand and also AI brand around the world. So Apple is right now the largest holding in the Buffett portfolio, and he holds its shares in the long term for its perpetual growth prospects. So over the past year, Apple shares have appreciated nearly in line with the performance of the S&P 500. It was around 35%. So this is something that makes Apple to stay in a quite probably undervalued ratio to the other companies that has gained substantially more. And the recent earnings report just released that Apple made a record-setting June quarter results with total net sales at a very, very high price, the cash level. So however, there are some concerns about the supply chain constraints that may impact the problems inside of Apple. There is also some expectation that headwinds are expected to be temporary, with no significant influence to Apple's long-term growth prospects and also valuation. So it's everything that sums up to this positive outlook for the stock. Right now, Apple is also expected to keep delivering unprecedented growth, as it was of recent. 3-year revenue growth rate is at a 12.8 level. That is highly satisfactory, and the only one thing that may bother is that debt to equity and equity to asset low level in comparison to industry, and is right now diminishing in relation to the history. But it may happen after this reopening economy take place finally, and we'll just get out of this supply chain constraints as mentioned. So lots of gauges are in a positive territory. P ratio, yeah, it might be lower, but we are right now in this growth environment, so don't really bother about this. In terms of earnings per share, next 5 years, it's around 20%, so it's very high. Also forward P at 26 points, so it puts Apple in a position that is favorable for growth. Also, average target price of analysts is at 164. That is about $14 higher than it is right now. In terms of a trade idea and this technical pattern, we can find that we are just have been broken out of this consolidation in a bullish pennant formation. We have just gone through this all-time high of January and retested it twice and confirmed that it's a base that may be useful for the future growth. So after this period of around 25 or even 35 days, we have found a chance for the breakout, and the breakout of this bullish pennant formation may get us as high as same length of this recent arm up to 170 bucks. So it's the highest target for this formation to succeed, and I would find this a little bit over past my personal targets that I show you in a second. But this ascending triangle breakout is confirming that the price target may get obviously over there. So this target is still in play. However, I would play a bit more cautious, and for price target for Apple, I would use this Fibonacci extension that might be useful and anchor this at 172 bucks I have appointed, and right now I can find that the 0.23 extension is right at the 160 level. So this 160 level just brings a opportunity to make something like a stop for this chart, when after getting to 172 bucks, we'll probably retrace back to this 0.23 extension, as price often retraces like that. So this impulse may stop at first stop around here. So 0.23 is my first target when I would like to grab some of my profits and take this off the table and just let the winner run up to 172 if succeeded. So I would make a trade idea and set the board like this, with a stop loss right below the middle of this recent ascending triangle, and the risk reward ratio in this term is at 4 points, so it's very high. Let's make a possible area of entrance for you if you just would watch this episode of Blockrevision any time later. So area of entrance is right at around 149 and 149 and 151.8. So when the price just get out of this limits, whether it's to the upside or downside, I wouldn't consider it. I wouldn't consider Apple trade as valid of this my suggestion. So remember, if entering anytime later, just adjust your risk reward ratio relatively. So if you just will enter within, for example, 149 area, I would just slide this risk reward ratio like this, so just to remain at this risk reward 4.15. So always remember to adjust your position to your risk appetite. Never risk more per trade than 2% of your trading capital, and always stay cautious and set some alarms or stop losses instead. That's it for now. Thank you very much for watching. If you have any questions, just put it in the comments section below, and see you tomorrow.